Hi, my name is Jerry Yu, the Family Money Doctor. Today I wanted to discuss with you one of the most talked about financial planning tools in the past few years. There are mixed reviews on social media about annuity. Some people will say annuity is great, it provides a lifetime income. But on the other side, there are people saying that annuity is terrible. A lot of people have heard the word annuity, either from their financial advisors or from their bank or from their friends. But what is annuity? And exactly how does annuity work? Today we will be talking about how to easily understand fixed index annuity. But before I get started, I would really appreciate it if you can click the subscribe and the like button. It will help me a lot with the YouTube algorithm. So let's get started. See, I frequently joke around that the insurance company are great at taking something so simple and making it complex. But picture this before we get started. Let's say that you are on a road trip with your friends driving through the Death Valley National Park. Everything is great, no complaints. Then you started to add on some miles and all of a sudden your gas tank is looked a little bit empty. Sure enough, the next gas station is not for another 100 miles away. So at this point, panic started to set in. Air conditioning gets turned off and all eyes are on the fuel gauge, and that's not a very comfortable feeling. But imagine this with people in their retirement savings. The fear of running out of money in their later years creates a constant state of worry. To avoid this, lifetime income annuity can act as that guaranteed quarter tank of gas, allowing you to get to your destination without having to constantly be looking at that fuel gauge. See, fixed index annuities are a great tool to supplement pensions, to supplement Social Securities. See, when you are retired and are in that red zone with 5 to 10 years out, it's now time to think how to start converting assets into income. See, we're going to talk about the two different phases of the annuity contract, the accumulation phase and the distribution phase. So we will start over here on the accumulation phase now. See, where we are going to answer the three common questions that we get from consumer. What is the expected rate of return? How does my liquidity work? And what are the annual fees? Now to answer the first one, expected rate of return. See, fixed index annuity contracts are built to replicate CD-like returns. So if people are selling equity-like returns, it's time to be cautious. See, with that said, we're going to earn on this accumulation value side anywhere from 3 to 6%. What about fees? How do those fixed index annuity contracts work? See, most of the time, there's no drag inside those fixed index annuity contracts. In other words, there's no fee during both accumulation and distribution periods. The third piece is the liquidity. A lot of time, these contracts have a small percentage that you can withdraw free of any charges, and that's typically around 10% per year on the account value. And you will notice a different account also exists above the accumulation value. That is what's called the income value account. See, that is used to earmark and determine how our future paycheck and our future pension dollars amount are calculated. So please remember, there will be two sets of numbers in your annuity accounts. One is accumulation value, which is your actual account value. The other is the income value or annuity value. Each insurance company might use a different wording, but this income value is used to calculate your future income from this policy. So day one, you will notice that the income value here is drastically higher than the accumulation value. That's by design. Since this account is artificial, they are typically going to throw premium bonuses your way or interest rate enhancements or rolled up rates that are guaranteed to amplify this account above the accumulation value. And as I mentioned earlier, there's also a penalty known as a surrender penalty. Now, these insurance companies are buying a large duration bond, so they are at risk if you were to surrender this policy and walk away from the contract early. So what they're going to do is apply a small charge which will remain level in the first couple of years, but then decline to go to zero after approximately 7 to 10 years. So should you not need the income later in life and you wanted to walk away from the contract, and there would be no more fees or penalty applicable to you, and you can take your accumulation value and walk away. So if we look at this example, if you put $100,000 into the accumulation value, then you will have a $90,000 day one in terms of your surrender value because of this charge, right? And now you have $125,000 on the income value, giving a 25% premium bonus to open this annuity contract. So over time, during this accumulation period, it's going to earn anywhere from 3 to 6%, a bit elevated on the income value side. And there comes a point when you decided to retire and need to activate the income. So what the insurance company is going to do is take the income value at the day before you retire, and they're going to apply a withdrawal rate anywhere from 4 to 5%, depending on your age and if it's a single life or if you choose a joint life option. What this percentage is going to do is initiate your very first check. The beautiful part about index annuity with certain insurance company is that your paycheck will increase over time. Typically, it will increase and outpace the rate of inflation. So what we have here is an increasing account on a depreciating asset that eventually goes to zero. But what doesn't stop is the lifetime income you are able to receive from this insurance company. Now, how do these insurance companies guarantee this income that increases? It's through the help of mortality credits. The insurance companies are large enough that they know the actuary tables and they know a pooled risk, so don't ever worry about whether or not they're going to pay it out. But that's depend on the claim paying ability. So it's very important to work with an advisor that can write an A-rated life insurance company, A-rated product, so that concern is completely eliminated from this discussion. One of the questions we typically get is, this is great. I love guaranteed lifetime income, but what about death benefit? And I heard once that the insurance company lock off my principal, and if I die, they maintain and retain those dollar amount. And that's why you see a lot of people on social media says annuity is bad. But remember, this is not your grandfather's annuity anymore. Okay? There is death benefit associated, okay, to this contract. Whether you die prematurely before you activate income or during the income payment stage. That death benefit is typically paid out in a lump sum or in a 5-year spread option. And your beneficiary can choose which option to get the payout. And you will notice that the income value here on the accumulation side will represent the death benefit payout. Okay, that's spread over 5 years, followed by the lump sum option, which will be the accumulation value that your beneficiary could also choose. Another question we get is tax treatment. You know, I love the increasing income. I love that it's guaranteed and I will not outlive that income. But how does the income get taxed? Annuity income is taxed as ordinary income. There is no capital gain tax, unfortunately. So this would all be calculated as ordinary income, whether it's qualified or funded with after-tax dollars. So we talk about a lot today. We talk about fixed index annuity in general, the accumulation phase and the distribution phase. And there's absolutely a need in everyone's portfolio to provide an additional paycheck to supplement pension and to supplement Social Security. And worst case, eliminate the worry of running out of money in retirement. See, we don't want to have you look at that fuel gauge in retirement and having to worry about if you will ever run out of gas. Fixed index annuity aren't so complicated as you may think and how they are portrayed. And they absolutely can serve as a necessary secure tool to supplement and provide security in your retirement portfolio. My recommendation is to work with financial advisors or insurance agents that could represent multiple insurance companies, because not all annuities are the same. Each company or each plan will have different features. Remember, there's no best annuity. You need the annuity design that is best suitable for your needs. Okay. I hope this video can provide basic understanding of annuity, and please discuss with your advisor to see whether or not a fixed index annuity makes sense for you. Thank you for watching, and I will see you in the next video.